You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, the website oilandgas-investments.com. Welcome to the show, Keith.
Jim, always glad to be here.
Alberta, what a difference a year makes. They say unemployment claims in Alberta have gone up 91% year to year.
You know, that's obviously only makes sense because of the oil price and the gas price. And I think a lot of people just kind of forget that how much of Alberta is actually tied to the natural gas price as well. But certainly in fact, even more than oil, but certainly oil has had such a calamitous drop that, it's hard. And of course, what happens here is a lot of these people, they're leaving high-paying jobs, really high-paying jobs, and they're not going to flip burgers, but boy, oh boy, they are not going to get a job back that pays anywhere near the one they just lost. So it's going to be a long, tough road in Alberta.
Well, Alberta's oil rig count has fallen by a tremendous amount, something like 200 rigs idled with only 75 in production right now.
Yes, and really the one thing that's even saving that is the Canadian dollar. So, if the dollar had stayed higher, that rig count would be a lot lower. So that one thing we have to thank for a lower dollar is really that Alberta jobless rate hasn't even gone higher. But these rigs here, we're getting more efficient with the rigs, and of course the service guys have been willing to cut their costs dramatically, so that's helping keep rigs in the field as well.
Is the service industry something that people don't really talk about or mention a lot?
Well, not so much on radio shows like this, Jim, but trust me, it's a very hotly contested topic in the industry, and the issue is that as the oil price rises here, how much should the producers get and how much should the services guy get, and that really is a big bone of contention between the two groups, because certainly the producers think they just got gouged by the service side over this last cycle from 2009 through to last year. So they're quite happy to see these services guys say, a little bit less, please. And the services guys say, well, hey, we've cut costs as much as they can. And you just listen to the producers and they say, that's crap. Look, there's still guys flying back and forth from eastern Canada and central Canada to the patch, not near as many as there used to be, but it's still happening. And there is a lot, like when we're talking about just 5 or 10% wage rollbacks, Jim, that just, in the eyes of the producers, that is just not enough. And there's no real, 5-10% isn't any real pain as far as they're concerned. So over the next, 6 months, if the oil price does start to perk up, you are going to see some fairly strenuous conversations between the producers and the services sector.
Do they really hate each other, or is it distrust? And how come you don't have companies that are both producers and servicers?
Oh, well, you got to focus on what you're good at. It's such an advanced, mature industry in North America that everyone's very, very specialized. And so you don't. You do see in the States sometimes a little more vertical integration, but that's mostly on the refining side. Down in the in the upstream markets, you don't see that as much. Certainly not in Canada. So it's all very specialized, and you got new technologies coming out all the time because of that. So that's what's driving innovation. If you're doing your own, and you're doing a service company as well as the producer, you're just not innovating at what you're really good at.
Have the Arabs achieved their goal of trying to drive shale producers out of business?
Yes and no. The reality is that obviously we're finally starting to see some production cutbacks, but it's still been really slow, Jim. Like we're only dropping probably 50 to 80,000 barrels a month in the States right now, and that's just that sounds like a lot, but honestly, it's not. Just because Asia and the Arabs can turn on taps that are like just one tap can equal that. So it's we really need to see production drop off quite a bit more, and really the service guys have cut their costs down enough that at these low oil prices, these guys are making enough money to stay zombie stocks for a long time. So where you're just making enough production to kind of keep the bankers off your back, but really production is not dropping that much, and that's kind of where we're at right now.
Where are they storing all this oil if we're making over 1 million barrels a day more than what's needed?
Well, a lot of it's coming to the States, and that's what I think is hiding some interesting information, is that, the huge imports coming into the States now, particularly into the Gulf Coast, is really starting to get a little worrisome. Now the States has done a good job at not only building more storage in the last 2-3 years, but they've also done a much better job at connecting all that storage. So even though we're dropping 50,000 barrels a month in production, if it wasn't for imports, the U.S. oil price would actually be quite a bit higher as we start to get some of these production drops happening. But the huge imports that we're seeing from all the other places looking for storage, that's what's keeping the oil price low right now. So, and they're starting to put oil into rail cars. Like, we used to use rail cars to transport oil. Now we're using rail cars to store oil.
Well, oil did have a pretty good rise this year, going from $26 to the $40 range. How sustainable is that? Will it stay around 40? The Trudeau government, by the way, its budget is predicated on a $40 a barrel price.
You know what? I think there's a good chance it could stay at $40, Jim. And really, the reason I think that is that most of the world is producing full out at complete full capacity. We've talked about this before, where the Saudis do have a little bit extra spare capacity that they could bring on, but not for any significant length of time. They'd have to go do a bunch of building new oil fields and infrastructure, of course, and Iraq is basically pulsing all out. Iran has another 1 million barrels. The States could turn around and add another 1 million barrels pretty quick. But that's about it. And so, without a lot of spare capacity here, I think there will be a little bit of pressure to keep oil up. But these, the reality is that there's so much oil out there that right now makes money at $50. That the likelihood of us seeing oil over $50 is pretty low. And if we do, cash flow should actually be really, really strong. And I think people have written off the energy industry as saying, hey, margins are going to stay super small. But I think that's going to be on the backs of some of the service companies still and some efficiencies. So I think cash flows could actually surprise investors at $40 to $50.
And we have yet to see the annual fire/explosion at a West Coast refinery.
Yeah, ever since Tesoro had that issue, actually it wasn't them, it was Exxon that had the Torrance refinery. You're right, a couple of years ago. That's put a huge wrinkle in the whole West Coast gasoline system and given us much higher gasoline prices over the last couple of years.
We'll have more with Keith Schaefer right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Keith Schaefer. Keith, the International Energy Agency says that investment in the oil business is at a historic low, and they say eventually that will lead to a shortage of oil. What do you see there?
Well, I think anybody who's prognosticating and guessing about what could happen 5 years out in the future is about as useful as screen doors on a submarine, Jim. Nobody has a clue where the hell the oil price is going in the next 3 to 6 months, much less 3 to 6 years. But I would say that, certainly a lot of the big infrastructure things that we've done here in North America with the oil sands and developing offshore technology, those kinds of projects do have long lead times, but I just think that, you're looking at the oil industry now, with the shale in particular, has very responsive times going back and forth. So whenever they need to take production off, they can do it quite quickly. Whenever they need to put production on, they can do it quite quickly. So that could happen a few years out from now, But I'm just not convinced that's going to be that big a deal. Even, there could be a year or two when all of a sudden we do need a few more offshore projects. But, the oil sands has the ability to ramp up production. There's lots of projects that are now half done sitting on the shelf that would only take a year or two to get going into production. So I'm not too concerned about that.
What about the brain drain in the oil patch? If people lose jobs, they go on, find something else that they're good at, maybe make a decent living out of it. Can you get them back into the oil patch if they're needed?
Yeah, I think that by far is the biggest issue. The brain drain, once people move off to have a different job, they're just gone. You're not going to take, once you've been through the boom and bust cycle once, it really scars your psychology. When you got to perform for your family and put money in the till, you really don't want to have to do that. And working in the patch is not always an easy thing, Jim. Like here in Canada, particularly in the urban centers, you don't realize some of the conditions that these guys have to work in. Like down in Texas, working those refineries, it's incredibly hot, dirty. For guys working up in the oil sands, that's you're away from your family for a long time. So it's not always. It's rarely fun working up in those kinds of environments. So if you're going to make pretty close to the same money somewhere else, it'd be a tough chore to come back to the oil patch.
Would they find work? If you're experienced in the oil fields, you probably have some kind of engineering background or mechanical background.
Well, and you just have a background of competency, right? That's the big thing. So I think that wherever you are, you just obviously have to do a little bit of retraining, but certainly if there was anything going on in mining or in gas, that would make life easier, but there's nothing going on there either. So it will make it a little bit different. So, potentially, Jim, if the money's there, these guys do come back.
A comment from the Japanese government. They say Canada is really missing the LNG boat.
Oh, I wonder what they mean by that.
Well, I guess you need boats to bring the LNG from Canada to Japan.
If they're missing the LNG boat.
Well, they're just saying there's lots of opportunities right now, but if we take too long, they won't be there.
Well, certainly, I know everybody and their dog right now loves to diss LNG. They love to say, hey, the prices are going to be low forever. It's like, that is just so not true. Like, we're only 5-6 years away from $8 gas. And these things take 4 years to build. So, to me, all the Chicken Little saying LNG will never happen in Canada, I just think that's ridiculous. I actually think Shell will go ahead. I think even Petronas will go ahead. Because, like I say, nobody knows what these markets are going to be like 4 or 5 years from now. And if oil does go back to $60, well, then LNG is quite profitable. The whole cost structure of the supply chain will readjust itself, Jim, and make it work. That's what we do.
And I know a lot of people look to atomic power, but Fukushima is still happening 5 years out. It is still melting down. And they say to cap it may cost $1 trillion if they ever do cap it. So obviously people would like to use something else for energy that won't melt down to the core of the earth.
Yeah, the other thing the anti-LNG guys, whether it's the First Nations or whether it's economists, don't get is that the Japanese just hate TEPCO. They just hate the big utility there with such a passion. The culture there is they would rather pay more money and not have nuclear anymore. So obviously economics are going to have a little bit of an impact, but people really underestimate the cultural hatred for TEPCO there.
How exposed are Canadian banks to the debt in the oil patch, and will they ever get the money back that they lent? Well,
great question. I think that the banks are slowly starting to put the screws to the industry, but they've been very cooperative about it. They've really basically said, "Hey, we got this large revolver. We got to term some of that out and try and find a way to get that get this debt down." And that makes it tough for these companies, and that's causing some of these companies to basically go under. We saw a little Terra Energy go under here this last week, and all these companies here that are being forced to sell assets into a market where there's no bid, it's just not pleasant for anybody. The Canadian banks have seen their stocks swoon over the last year and a half. I think a lot of it was because of this issue, but I would say that nobody's really that worried yet about some of the Canadian banks having any great distress because of these things.
Is it because Canadian banks historically have been reluctant to lend money unless you really are good for it?
Yeah, the Canadian banks do have a track record of being a little bit more conservative than their American counterparts. I'm just looking at the chart of the Royal Bank here, the 3-year chart, Jim, and it definitely did peak right at when oil peaked. It would in August 2014 is when the Royal Bank hit its high point. So and then it just fell down as oil prices just went down. You can totally lay a price of oil over the price of the Royal Bank, and it's not that much different.
Would banks be willing to foreclose on a big oil company?
No way. Here's what a lot of investors, and certainly the man in the street, doesn't get. Okay, so if you've got a fairly big client and you are going to force them to go into bankruptcy, you will never be in any financing syndicate again for 10 or 15 years. So that's where these guys make all their money, is raising money through their brokerage arms and investment banks for private industry. And if you are the guy that pulls the plug on somebody, you are dead meat in the books of the industry, and you're going to be cut off. Like you better make sure that loan is almost going to save your bank. Otherwise, if it's a $30 million loan, you're for sure going to eat that loan. And if it's a $300 million loan, well, then that's a different story. You have to work with that. But no, you are not going to see any of the banks pull a big power trip on any of these big energy companies, service companies, or producers. You're going to see them work hand over fist to try and stay involved and be cooperative. There's just no way.
Well, on some of those big accounts, don't they assign almost a whole department to look after it?
It could be, Jim. I don't know, but it is surprising, I think, to the man on the street to hear that what the culture is in that world. It's not what you think.
A lot of people claim that because Toronto's the banking center of Canada, but nowhere near the oil patch, they don't understand what goes on there.
Oh, I don't know if I believe that. Energy has been a big enough piece of the pie for a long enough time that,
They've learned to roll up their sleeves and take a look for themselves.
Well, the reality is it's asset-based lending. That's the kind of stuff the banks are actually good at. So that's not that far out of their realm of thinking. They love asset-backed lending. That's their raison d'etre. So, and with oil and gas, you have that.
Keith, anything else you wanted to mention about the energy business right now?
Well, Jim, the only other thing I'd say is that, the AECO basis for Canadian natural gas prices, AECO is the benchmark Canadian price out of Edmonton, AECO, Alberta Energy Company. So normally we trade around 40, 50 cents less than the Americans, and now we're trading about 90 cents less than the Americans, and that's because our gas, Marcellus gas is still coming into the U.S. Midwest, and our gas production here is still increasing. We were declining for quite a few years in Canada with our gas production, but in the last year and a half we're back increasing again because of the Montney play, and it's just happening at a tough time when everybody south of the border is ramping up production continually, even through these low prices. And no one's making money at these low prices. It's just insane. But because we've got zero interest rate, everybody's still pushing that envelope. So we'll see. Bentech and Springrock are the two companies that have really that monitor the pipeline flows, and they keep telling us that we are hitting new records pretty regularly. We hit an all-time new high in the States in February of this year. So despite prices being, $1.50. So
they have increased consumption of natural gas simply because companies that maybe use some other energy source have switched to natural gas because of the low price.
No. Well, low prices increase demand. So, and we have seen that in the baseload power in the States, but certainly because of the warm winter we had, all that just got negated by such a huge drop in residential. In fact, even in Alberta, my God, Jim, they're going to leave storage withdrawal season damn near full. Like it's just crazy. I'm pretty confident you'll see gas go no bid in Canada on some weekends this summer.
Wow. Has that ever happened before?
Yep, yeah, it has. Not for quite a long time, but yes, it has happened before.
Keith, thanks a lot for chatting with us.
God bless you, Jim.
My guest has been Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, the website oilandgas-investments.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our YouTube channel, Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.